Yep.
Hello, can you
I'm
hear me?
back.
All right, you're back. Okay, good.
Sorry about that.
No, it's fine. It's fine. All right. So, all right. So can you hear me?
Yeah, I'm hearing you.
All right. Good. So, let's go to this thing. So let me just I want to put in something on this so that I can clarify. If there's anything you didn't understand, I want you to ask questions.
Yep.
So we have our high, we have a low to a high.
Yep.
This is our first swing. This is our first swing structure. Then what happens?
Yeah.
The market transacted here. So I'm going to put this as a transactional liquidity. The market transacted here. What do we have? From this high to this low is our first swing structure, right? So from this low
Yeah.
to this next high becomes our second swing structure.
Yep.
This becomes our second swing structure. From this here, this low to this high becomes our second swing structure, which makes here transactional liquidity, right? Because the market has
Liquidity.
transacted.
Yeah.
So once there is this transaction, this becomes what? Our next area of interest. From this low to this high is our third area of swing structure.
Oh, sure.
This makes sense to you, yeah? So, and so forth and so on,
Yeah,
right?
I'm following.
So, every time the market creates a new level, takes out a new high, like this, for example, this to this level, from this high, from this low to this high becomes our swing structure, right? So every time the market
Yeah.
creates a new level, for example, if the market does something like this, comes back and continue, this is a swing structure. Every time the market breaks a high, it creates a swing. Now, it is for you to be able to identify this swing, and that is why it's very important to understand market structure. It's not people confuse the name for thinking because obviously market and it's market that has a structure. It's for you to be able to demystify the name, the mystery behind the name, and try to understand what it is that is really happening in the market. And the only way you can do that is to be able to break down the market gradually this way to understand that every time the market does something, every time the market does this is a high, the market does this again, this is a new high. So this new high and this previous high is the same thing. The only difference is this was a swing, and now this is the current swing because this swing has taken out the previous swing by taking out the high, right? So this becomes our new swing.
Yeah,
Are you getting the point now?
yeah, I'm following.
All right. If you have questions, you can ask me. I will answer. Can I go on?
Yeah, so basically, well, as long as you could identify the overall market structure, and then you could identify the substructures and the minor structures together, you could just work out all of this.
Sorry, your question again?
Yes, as long as you know the basics of market structure,
Okay.
And then you get to understand the substructures
Yes.
and the minor structures and like how the swing structure, the first swing will begin. Then
Thank
you
you.
get the transactional liquidities, then the second swing. Until you will continue doing that until there's a change.
Until there's a change in the market, there's a change in the trend. Then you just continue with
Yes.
the new trend. Yes, you're getting it. Yes, yes.
Right, right.
All right.
I get that. Yeah.
All right. So now that we have gotten that, I need to then show you how to start looking for your swing the way we look for a swing. Now, obviously, I have taught you basic market structure, right? So we
Yes,
should
yes.
start, we can then leave that and start going into advanced market structure, which is where we are going into next. Just give me a minute to play this stuff. So stuff. I don't want to clear my chart. I would have just wiped everything once. I'm too lazy to do the chart again. So yeah, we're good. Okay. So I'm going to just take this up because I need a whiteboard for you to understand what I'm talking about. This is where you need to pay close attention to because this is what we need to understand the market, the way the market truly works. All right, so the test. Okay, so we have advanced market structure. Generally, we
Mhm.
already know the market does something like this, right? This is basic. This is basic, very basic.
Yes.
Now, sometimes when you follow this basic, you realize sometimes because we want to, obviously the markets, once you see market doing this, once you see the market doing this, your very whole perspective idea of trading this kind of market is to wait for the market to come back to this level, right? Set your pending order, stop loss below the previous
Yeah.
low, right? Stop loss below the previous low, set your pending order. So the market comes for the pullback that we're expecting to happen since it's a trending market. Market comes into it, creates a new high, right? But sometimes,
Yeah.
or not even sometimes, most of the times, what tends to happen is the market does this and continue, right? You've seen this happen to you in the market, obviously. We've all seen it.
That's where liquidity comes in.
Exactly. We've all seen this happen in the market. The market does this and takes you out, but then still buys, still goes into the direction. Then you start wondering, but you
Yeah.
are right. Why are you mitigated? Why were you taken out of the market before the market start buying? You've only failed to realize that there's a key point that you're missing in the market. The basic market structure tells you you should just do this, buy from low, sell from high, buy from low, sell from high, buy
Mm.
from low, sell from high. But it has failed to tell you which part of the low you're supposed to be buying from and which part of the high you're supposed to be selling from. You understand? Now
Yeah.
that is what I'm here to shed light on. So let's continue. So this is basic market structure that I've just shown you. Let's look at the advanced market structure. So when you talk about advanced market structure, now I want you to remember everything we are doing now. We are going to be bringing swing structure into it because swing structure is what we need to identify where to take our trade for the next level. Once that level is taken out, our next level is going to get another swing where we can, formulate our trade for, our next trade action to happen. You understand? So,
Yeah.
so we have this. The market does something like this, comes down, does something like this. Now, before the market can easily continue, before the market can easily continue to the next obviously, basic market structure says this. It comes down here, right? And then
Yeah.
continue to the next high. But that's not what we are trading here. We're not trading basic market structure. We're trading advanced market structure, which is what the market really is, which is what the federal banks and reserves, all of them, they are trading. They're faster than us, obviously, because they have developed their bots to be able to catch these trends, to be able to create these fake outs, these things, for them to catch it before any of us could see it with our naked eyes. You understand? But they've left a footprint, and we can only follow the footprints they leave. So when the market does something like this, instead of it to just create a low, does this and go to, and continue to the high, and continue to the high, what it does is this: it comes down, mitigates this previous low here that it has created. It's only after this low has been taken out completely that the market can start buying. So that the market can start buying. Do you understand this? Now,
Yeah.
we have this as our basic market structure. Have this, right? And then we have this as our advanced market structure. Before the market can buy. You see the difference?
Yeah.
The difference is very clear. There was no mitigation of any kind on these levels, right? But here we have that we saw that the market came, mitigated this area, this level, took out this level before buying. Did you
For
see
buying
that?
again, yeah.
Before the new buy happened,
Yeah.
before the new level was created, there was a mitigation. There was a clear mitigation on this level before the market decided to take up to the next high. Now this, remember when we were talking about minor structure, substructure, and the rest?
Yeah.
This, remember this is your substructure. Before the market, the market creates what? A high, substructure, minor structure, continuation, right?
Yeah.
So this substructure, I told you earlier in this class, this substructure can either be called what? Substructure, structural liquidity, or correction. So this correction here is what the market has to mitigate first. The market needs to mitigate this correction with another what? Correction, another substructure or structural liquidity before we can have our major minor structure or continuation in the market. I hope this is making sense to you.
Yeah.
All right.
Following.
All right. So now our aim in the market is to be able to identify this level, is to be able to identify this whole thing before the market decides to buy, decides to either sell or buy. So from here, I'm sure you know what I'm about to say next. From here to this high becomes our swing structure.
Structure. Yeah.
We don't need that one anymore. So from here to this high becomes our swing structure. We have our transactional liquidity here. We have our transactional liquidity here. Now, in this strategy, you need about two swing structure formation. But this was a swing structure, right? And this is also a swing structure, right? We need two swing structure formation for you to be able to get the trade you're looking for. So the low of the next swing structure, which is our substructure or structural liquidity.
Yeah.
Our substructure or structural liquidity becomes
So you're expecting the market to take liquidity before going again.
becomes
Right, right.
our liquidity zone. So I'm just going to put
Yeah.
XS, becomes our liquidity zone, right? Becomes our area of
Yeah.
mitigation center, becomes our liquidity zone. So instead of using this as your entry, this area as your entry, as before, for for a
Yeah.
buy, and this is a stop loss. The stop loss of every other block traders and many what have you, right? Their stop loss becomes your
Mm-hmm.
words, becomes your area of entry. So
Entry.
you
Yeah.
you now know that this is your area of entry. You are going to enter this trade from here. The stop loss is the previous low. Are you seeing that now?
Yep.
Need
Yes,
to,
yes.
need to move this. Sorry, need to move this. Yeah. So you can see instead of using this as your area of entry, this becomes as your area of your stop loss. This becomes your area of entry, and stop loss is
Yeah,
back
entry.
to this previous, the first low. So this is your
Yeah.
transactional liquidity. I'm going to label it just for understanding purposes. This is your transactional liquidity. So from this low to this high, we have our swing structure.
And structure. No, this makes sense.
You see it now? So
Yeah.
we have our swing
Yeah.
structure.
Yeah. Okay.
So once we have identified our swing structure, what are we waiting for? We are now waiting for the markets to do
Mm-hmm.
what? To do this, mitigate, and take out the next high. So this is our entry.
Yep.
The market taps into our entry because we have a pending order resting here. The market taps into this pending order and buys,
Yeah.
and you make
And
your
then goes
profits.
again.
And then you start all over again. After the market has created
Yeah.
its the legs and all, you start all over again. So the next move here will be, sorry, I need to bring this thing down. The next move, bring this down. So the next move will be this. Let me remove this 1st.
Mm-hmm.
So we have a pullback, right, into this area, a continuation.
Yeah.
Here
So there's our next swing structure then.
exactly. So here becomes our current low,
Yep.
transactional liquidity,
Transaction liquidity.
transactional liquidity,
Yep.
structural liquidity.
Liquidity.
This becomes your entry again, right? And stop loss is below here. Your target is always the previous high before the market
Yep.
started dropping. So market drops into this level and buys again.
Yep.
So instead of your usual, what's it called? Your usual high and low, you're beginning to see the difference now. You're beginning to see that, oh, the market plays a different game here. It's not the usual thing that we know. You understand? So
Yeah.
what do we have? Let me show you something. So what do we have in this place? We have a complete let me pick up a circle. If I can remember where to get that. Me too. kind of mark out something. I don't know what that is. Anyways, so we have a complete this is our first swing structure. Right. This is our first swing structure.
Structure one.
So this is our first swing structure. Do you understand? And this here is our second swing structure. From here to this high. Because of our second swing structure. So instead of trying to, do the regular thing the market does, high to low, high to low, high to low, you now know that you are expecting the market to do this first, to take out a low, buy, then repeat. Hope this makes sense to you. I mean, I know when you're watching the video again, you're going to get a better understanding, but I hope you're getting. Yeah, all right. So
I'm following, yeah. I'm picking it up, yeah.
All right. So now let's go to the charts, right? Let's go to the charts, and then let me show just a few of these in the charts so I can have a better understanding of what. I'm going to open a new Euro USD charts, so that we can look at it closely together. Delete this. Delete this. USD. Okay. So we have this. I'm just going to open a new. I don't want to use this current market section, so let's go down. All right, so let's look at this place. This market was selling, right?
Yeah.
This was the previous level of interest. The market mitigated this level quite all right. You can see it. This high was taken out, right?
Yeah.
So this is simply liquidity that has happened. The previous liquidity that has happened. So we have this high get taken out by this high. What does this high do? It creates a low, creates a high, and comes down to this low. So what becomes of this place? This becomes our swing high. So I already have something labeled for that. So we have swing high.
Yep.
And this becomes our swing low. Right? This becomes our swing low. You can see it.
Yeah.
Where is our structural liquidity? Look at it
Right there.
here. And what do we have? Structural liquidity. Now, I needed to understand that. I picked a random situation. You literally saw that I went away from the previous market action where we have our currents. I mean, I've already analyzed all those parts, so I don't have knowledge of these places. This is random market action. This is random place. But because I know what I'm looking at for, I know where to look out for my swing highs and swing lows in the market. Assuming this was the current area of the market, I would not be trading. I would not be trading on this level. I will not be trading here. I will not be trading here. I will have no issue. I have no reason to trade here or this place because I know these are liquidity area until the major level, which is here, the market comes back to this level. Yeah. That is where and where and when only that I am permitted to take a trade in this market. And what happens with the moment the market comes back into this place? What do you have? Market comes below, just drops, keeps dropping. Do you see it?
Yeah.
So it is a very simple. This strategy teaches you patience. You must have patience. You must learn how to have patience. Because
Yep.
this is a very simple 1 to 3, 1 to 4. What is the stop loss? Stop loss is right here. 36 pips for back to previous low for 200 pips.
Whoa.
This is a beautiful trade, is it not?
Yep. It's a very good trade.
Now you caught this trade on the 31st of December. That was when you saw this swing structure set up. So you put it, set your pending order and just look away. When did it happen? It happened, matter of fact, it started on the 6th of January, came back, retested on the 7th, and the trade ended on the 10th. It took a long time, but it was a profitable wait. There was no drawdown. If you look at it, there was no drawdown. We didn't have drawdowns here. Market did not come and get to this level before dropping. No, there was none. The reason is because you've already taken out the reason for drawdowns, which is you've identified an area of interest, which is this level, the most important place. And the moment you identified it, you waited for the market to come back into it and you sold. Now, this is a sell version, so let's look for a buy version. All right, so we have, let's look at this place, for example. We have this level get taken out, right? This becomes our low.
Yep.
And it becomes our high, current high, assuming this hasn't happened. But what happened? The market never comes back into this level. This is an area that is supposed to be mitigated. It was not mitigated. This is an area that's supposed to be mitigated. It was not mitigated. So these areas, let's see what happened if the market has visited them in the future. Let me keep this here and let me keep this here. Let's see if the market visited them in the future. Are you seeing it? Are you seeing it?
Yep.
The market mitigated this level. What happened? Boom. I actually called this buy. I did. It's on the group. I called this buy. Market came back into this level and just boom. But there was this gap that's opened up and boom, just kept buying. You see how functional it is. It's just for you to understand it, learn it, and then I will teach you how I mitigate my losses with it. Because there are sometimes you're going to miss some trades. It's not 100% perfect, but I can assure you it is 85% perfect. You understand?
Yep.
It will give you exactly what you're looking for in the market. It is bound to give you exactly what you're looking for in the market. Someone with my kind of eye and knowledge already, I know this to be a low that was mitigated, right? So this is my current low.
Yeah.
I need this market to come back. This is high. So I need this market to come back. And what did it do? Came back, mitigated it. Our low is still very much valid. What happens? It buys, takes out the high, and you're profitable. You just repeat the same thing, intertrade, rinse and repeat, rinse and repeat, rinse and repeat. What do we have here? We have a high that got taken out. Look at this. We have a high. So the first thing you should always aim to identify is a high that was taken out. The previous high was taken out by this, created this guy, came back, created this guy, did this, did all this to this level until the market came back to claimed this previous high.
Yeah.
The market didn't sell. So what did it do? It came back, look at it, claimed it. And after it claimed it, what happened? That was when we got this drop that opened with gap even. You understand? So it's just how the
Yeah.
market moves. This is how these guys trade. This is how the big firms, banks, this is how they see their trades. This is how they're able to mitigate the losses in the market, how they're able to take their trades and easily move with the market. Right here, although this low was not taken out, we have this guy here. This is the liquidity resting here. What happens? The market comes into it. Was this low mitigated? No. So this low right now still holds. So if you had entered this trade for a buy, with a stop loss right here, TP back to the previous high. If you look at it, what do you have? TP has been hit, right? It is the same thing over and over again. So just a recap, that was the first, what I'm showing right now is the very first one. This is the very first pattern, and we've looked at the first pattern of our strategy. This is the very first pattern, right?
Yeah.
On Saturday,
it's not always gonna be as clear cut as how you have it there. You don't even know how to spot it.
Sorry, I didn't get that.
It's not always gonna be as clear cut as how you have it on your chart here. The drawing. It's got you have to know when to spot them.
Yeah, you have to know how to spot them. Is being able to, how I was able to really master spotting this pattern was this, yeah? Whenever I want to analyze my markets, whenever I want to look at the markets, right? I draw this down like this. I just draw it down a little. I just draw the pattern I'm trying to search for. Just draw it down. So let's take, for example, I want to see, all right, I want to see this buy that I just spotted right now. The first I'm going to look out for, obviously we have a low here. We had a low, right, that was taken out, right? We have a low that was taken out. So I'm going to look out for this low that was taken out to be able to see what is happening. If you remember when I started this, I said this low was not necessarily mitigated, but it's still a valid trade. So what I'm going to do, like, let's use this as an example. So if I'm trying to see if, first of all, I want to see what the market is doing. What is the structure saying? Is it buying or selling? Right? Right now, this market is trying to have a change of direction because it's been selling for quite a number of years now. So it's trying to have a change of character right now. So we are in a very, very tight zone. This is a very, very tight zone. We're just trading on weekly. This is just simple accumulation happening right here. You can see it. This is just simple accumulation happening right here. Until we have this level gets taken out. Matter of fact, to have this level get taken out, we are still going to keep accumulating, or we see this level get taken out first. When we take this level out, we are going to still have a pullback to the downside to claim some orders that are going to be resting somewhere, right? To claim some orders that are going to be resting here before we can continue. But right now, we're just using this influence of the big candlesticks, which is the weekly and monthly, to trade on the 4 hours until we have a clear cut on what the market is going to do. We'll keep seeing these moves, we'll keep seeing these patterns. So right now, what I do anytime I want to, identify these patterns, I draw the pattern I'm trying to look out for in the market. Once I have it drawn out, I'll start looking out for anything that looks like this. The ones that has happened in the past and the one that is about to happen. So the moment I start looking at for the ones that has happened in the past, I'll be able to see it in the future. You understand? I'll be able to see it in the current chart so that I can see what is going to happen when the market opens and how the market is going to, accept the whole thing. You understand? Like this trade, I took I had this open in the other chart, so you can see, I saw this level and this high.
Mm-hmm.
So what am I going to do? I'm anticipating the market to come, even if it's not going to be a very huge sell-off, the market should come and respect this level a little bit. And for someone like me who likes to do, sometimes I just want to take 10, 15, 20 pips. This is about 50 pips already. That's a lot of money, right?
Mm-hmm.
And I'm out of the market waiting to see the market happen again until I'm able to, if it comes into this level, I decide to take out this level and continue selling off, then it's going to hit my TP. But if not, I've secured a little bit of profit already, right? So I always advise, as you're watching this video now, just after watching the video, go to the charts, draw something like this out, your first pattern, identify it in the previous charts. Through our next class, it will be easier for you to understand. So this is going to be the end of the class for today. By Saturday, we'll continue for the next class.